Hello everyone and welcome to a very special PropertyInvesting.com webinar where tonight we're going to ask and try and answer the very interesting question of can you still make good money from real estate today in 2025 given what's going on with the world and Trump and tariffs and today's interest rate shock of it not going down like the majority of people thought it might. Well, there is a lot to talk about, and I'm glad that you have joined in. If this is your first webinar with me, then a special shout out to you. It's great to have you as part of the team. In fact, I've got a little poll question to get us going just to see who's in the room, as it were. And you'll see the question that is open at the moment is what level of investing experience, property investing experience, would you say that you have? Would you say that you're a beginner, an intermediate, or an advanced? Depending on your answer here, it'll help me to potentially tailor or cater for the presentation tonight. I'll give you 5, 4, 3, 2, 1, and let's shut it off now. We'll close it off. So, interestingly, 17% of people said that they were a beginner, 67 are intermediate, and 16% are advanced. Excellent. Nice to know. What is a webinar? Well, if you've never been on a webinar before, where have you been? A webinar is an online seminar. I've been running webinars now, oh golly, it would be for over 10 years and probably over 15 years. In fact, I remember when we wrote our very own webinar software and we started, it must have been in about 2003 when we did our first mentoring program, results mentoring before I sold it. And I remember doing a webinar for results people 22 years ago. Wow, hey. There is not a copy of the slide deck tonight, so make sure that you take lots of notes. There will be, time permitting, some time at the end of the webinar in order to answer questions that you might have. And there is a recording of this webinar. I will send you out a link when it becomes available to watch the recording in case you have to jump off early or I say anything that is interesting enough for you to want to listen again. What are we going to talk about? We're going to start off tonight with a little bit of Property Investing 101. Then we're going to move on and talk about what's working and what's not working. I'll have my real deal 11% positive cash flow to share with you. And then just before Q&A time, I'll talk to you about the details of a very special offer that you may be interested in partaking in if you want to learn from me how to be a better investor. Well, there's a lot to get on and chat about, so let us jump straight in. Part 1, Property Investing 101. Now, when I started investing in real estate, I had barely read a book on the topic. I knew what I knew from accounting. I knew a little bit about negative gearing. But in 1999, when I went to buy my first property, I was an absolute newbie. I knew very little, despite being an accountant, about how it all worked, very little about strategy, and just thought you bought a property, a good property in a good location, and that made it a good asset. In fact, I remember telling other people you should never buy property in the country for no other reason other than someone had told that to me once, so I thought I would just repeat what I knew. How things have changed now. So if you're in the 17% of people who are joining me tonight who said that you're a beginner, I know how you feel. It's been a little while now. Back then I had hair and probably a skinnier tummy, but we all start off being beginners. And I wish someone had have sat me down and said to me, all right, Steve, here's a little bit of Property Investing 101. Rightio, so when you buy a piece of real estate, how do you make money out of it? When I say 101, I mean the absolute beginnings. There are only two ways that you can make money out of real estate. The first is you take the income that you get and deduct the expenses that you pay, and that gives you your net income, or income less expenses. Now, some properties, in fact, Many properties, when you put debt in and having to pay interest costs, the expenses become higher than the income, which means you can't make any money out of income. Now, if we move away from accounting terms of income and expenses and just look at cash in and cash out, these properties where the expenses are higher than the income are negative cash flow properties. And if you can't make any cash flow from real estate, you can only make growth returns. Growth occurs when the value of the property goes up over time. Now, this is what we call a stupid question. Would you rather have two ways to profit from real estate or one way to profit from real estate? Answer in the little question box right now. Would you rather have two ways to profit or one way to profit? Of course, you would want to have two ways to profit if you could. Here's another question. If you buy property that loses money because the expenses are higher than the income, how many loss-making properties do you think you can afford to own? One, maybe two, possibly three, because that loss then needs to be funded from your other sources of income, whatever it might be. Now, when we add on our net income to our growth return, we get our total profit. Now, with this in mind, we think to ourselves, we want to buy real estate. We know that real estate can make a profit. Ideally, in the absolute best case scenario, we'd have net income and growth. But if we have a situation where we have net income and no growth, at least we're getting paid. But if we have a situation where we have negative net income but we have growth, we're making money on paper but losing money out of our bank account. Now, in all of these possibilities, that combinations and permutations of real estate investing, Steve McKnight remains a strong advocate that you want to try and invest in real estate in a way that empowers you to own an unlimited number of properties that put cash in your pocket. Now we have to ask ourselves, what do these properties look like and how do we get there? Because there is a difference today compared to when I started investing in 1999. The next thing I need to talk to you about is the difference between a realized and unrealized profit. A realized profit is a profit that can be converted into cash. So if your income, your rent is greater than your expenses, that is a realized profit because you can look at it and go, well, my bank account's going up. Contrast that with an unrealized profit, which stays only on paper. If the value of your asset goes up, nominally, let's say you bought something 5 years ago for $500,000 and you're told that today you could sell it for $700,000, you're sitting there going, hip hip hooray, I made 200 grand, but it's unrealized because it's not in your bank account, so it's only a paper profit, not a cash profit. And here's the aha, right? Real estate investing 101. Realized profits feed you, whereas unrealized profits flatter you. You might be able to point to your spreadsheet that says, oh, my net worth is boom. But if your net worth is predominantly unrealized, then most of your wealth is unreal. If the majority of your wealth is realized, then it is real because you can spend it. You can't use capital gains to pay for groceries. So now we come back to the start again and we ask ourselves, right, well, if there's only two ways to profit from real estate, which way is the better way for me? Move on to Steve McKnight training. And we look at this thing called the property matrix. And we look at the two ways that you can make profit, which is growth or income. And there's two ways that you can make that profit. The driver can either be what I call generic or the market, or it can be manufactured by an investor if he or she or they use their skill and expertise to find opportunities, as I'll share in a second. Now, if that sounds a bit, haven't heard that before, let me rephrase it for today for you. There's two ways that you can make a profit in real estate. two ways to make a realized profit. Let me clarify. Either cash when you cash in your growth, or cash flow from your monthly cycle of income in, expenses out, net cash flow in your pocket. One more time, if we just focus on realized for a second, there's only two ways to make a realized profit: cashing in your growth, cash, or cash flow, which happens periodically. And there's two ways that that realized profit can be generated: either by the market, which we'll now call M, or by the investor, which we'll call I. So we ask ourselves the question, this is all fascinating, Steve, but what is the actual purpose of investing? Now, more recently, I've been teaching people there's four things you need as part of your wealth system. And this was covered in my book, Money Magnet, which I've just finished the series on, webinar series on. We want to make more, manage better, multiply faster, and add meaning to our money. And when we talk about investing, we're at the third step. We're at the multiplying part of that equation. Making it is probably for most people about swapping their time for money. Managing it is making sure what we earn sticks, turns into savings. So wages turn into savings by spending less than we earn. And then multiplying it is turning savings into capital by deploying it. And the formula for turning savings into wealth is our savings deployed as capital multiplied by 1 times the return that you can get from your investing to the value of time. Now, I'm not going to explain this formula in more detail tonight, other than saying when we're talking about multiplying our money, we're talking about the rate of return that we can get. Clearly, the higher the rate, generally the better. And when it comes to time, we're talking about our time invested in the market. And practically that means the later you leave it in life, the less benefit you're going to get from compounding. Or said sooner, the sooner you get, said differently, the sooner you get into investing, the longer the benefit you'll get from compounding. Many of you have probably heard of the rule of 72, but for those who haven't, the rule of 72 is one of these rule of thumbs where you divide 72 by the rate of return that you get on your investing, and that will give you roughly the number of years it will take for you to double your money. For instance, if you can get a 6% return on your capital, then 72 divided by 6 means it will take 12 years for your money to multiply. That's great. What rate should I use in my rule of 72? Because we want to multiply our money as quickly as possible. Well, the realized profit would be the cash flow return on an asset. And if you've got a realized loss because your expenses are higher than your income, then no amount of multiplication is going to help you because you're in a trading loss situation, if you like. Who wants to start a business that trades at a loss? Who wants to start a business that loses money day-to-day operations, but you hope to make a profit by someone coming in later on and buying your business off you for more than you paid for it? Sounds a bit sketchy, doesn't it? Then you've got the unrealized profit, which is your capital growth return expressed annually, or your total profit is both. So here's what I say. If you are investing for income, just use your cash flow, right? Don't worry about growth. Growth is gravy on top. If you are going for growth, then you've got to factor in cash flow and growth, because nominally I'm willing to bet if you're borrowing for the asset, then you're going to have a negative cash flow return. So your growth return has to offset. Why am I even telling you any of this? Because I knew none of this when I got started. Had I have known even the basics of how real estate works, the two ways to profit, the difference between realized and unrealized, I reckon I would have gone about my investing quite differently to what you may have read in 0 to 130 properties in 3.5 years. In any event, what's the goal of investing? The goal of investing is not to own 130 properties in 3.5 years. That's the flattering part. That's not the feeding part. All right. That's the attention grabbing part. Your investing should only exist to provide you with the financial resourcing for you to achieve your non financial desires. For me, that was not having to work as an accountant anymore, so I needed enough positive cash flow to no longer have to sell my time by 6 minute intervals. And therefore, our goal of investing, which is to make a profit to fund our non-financial outcomes, has four parts to it. You may have heard me say this before. We want to make the most money, but we don't want to make the most money in isolation. We want to make the most money, and we want to make it in the quickest time. But that's not all. We also want to do it for the least risk. And lastly, added after I started investing in the United States, for the lowest aggravation. And we'll look at a case study later on tonight that will really bring this saying into focus. When should you buy then? Because we're talking about, can you still make money in today's market? Well, you should buy when the upside profit, it outweighs the downside risk by enough of a margin to accept the aggravation of investing in the first place, and the risk for that matter. This all sounds a bit esoteric, Steve. I'm still not entirely sure how to apply this in practice. I understand. We're just at the theory at the moment. It'll all come together in a second. So what are you buying when you buy real estate? This is really important because this is a major difference in the way I teach versus how other people teach. Are you investing in an asset? No. The asset is the vehicle to achieve the result. What you're investing in, if it's not an asset, is what do you think? Steve, I thought I was buying property. No, that's what you're going to invest through. What are you going to invest for? Right? And we have to answer this question before we can answer, can you still make money in today's market? Everyone's gone quiet. Thank you very much. Hopefully you're still awake. The answer is you're investing in outcomes. Because that's why we're investing in the first place. We want an outcome from our investing that will allow us to progress towards achieving a financial outcome that will allow us to progress towards achieving a non-financial outcome. Now, I've realized, and it's taken me a while to realize, that many people's a financial outcome is more, but they've never quantified what more looks like. And because they've never quantified what more looks like, they're trying to achieve a goal. They don't know what it is. And so they get confused about what to buy because they simply want more, and every property promises to possibly help them with their goal of more. But they don't ask more what? Do I want more cash flow? Do I want more growth? Am I making it in the quickest time for the least risk and the lowest aggravation? And how does owning this asset propel me towards my financial goal and propel me towards my non-financial goal? The right asset for you to acquire is the one that will deliver the right outcome that you are looking for. And therefore, a property that might be right for me may be wrong for you, and a property that may be wrong for me might be right for you, because we may have a different amount of profit that we want, or the type of profit, our time, our money, and our risk and aggravation tolerance. So can you still make good money from real estate today? Absolutely, if you can identify the right property that fits the outcome that you're trying to achieve. If you don't know what outcome you're after, then you will never know what is the right asset for you to buy. And in those circumstances, what people tend to do is go to a buyer's agent and say, can you find me a good asset? And hopefully if I buy a good asset, I'll get a good outcome. Whereas what we need to do is we need to say, hang on a second, there's so many assets out there for sale at the moment. Let's try and narrow it down because we can't look at all of them. Which one of these assets is going to make the most sense for me to focus my attention on? So with that in mind, let's push on to part two, what's working and what's not working. So can you still make money? Well, what works best and what's most effective will change over time. Makes sense. Interest rates go up, interest rates go down. Rooming houses these days are a lot more popular than they used to be, for instance. Commercial properties are a lot more popular than it used to be. But my saying is, as long as people live in houses, you can make money out of real estate. That doesn't mean that every property goes up the same amount or even goes up in value and has the same cash flow outcome. What we want to do and how we want to differentiate ourselves is we want to use our skill and expertise as investors to identify and buy opportunities and turn them into outcomes. This is how you'll make the most money in the quickest time for the least risk and the lowest aggravation, by being equipped and investing in yourself for the skills to be able to find and buy opportunities that the market doesn't understand, and then convert or transform, fix, if that's the word you like, them into outcomes and get paid for doing so. What does this look like practically? Well, I'll give you an example with one of the properties that I've bought in the last 6 months, where there was a structural problem with the tenancy and a risk that the rent might go down. And by using skill and expertise, I neutralized that risk. And I've been told this week, as we got the property revalued, that there is a 7-figure increase to the property's value as a result of acquiring the opportunity and using skill and expertise to add value to it. And it's not me coming up with what the value might be, it's an independent expert valuer. So you will be able to make money in any market at any time, provided you have the skills to be able to identify and buy opportunities and convert them or transform them into opportunities. Can you make money, good money, in today's market? Well, if you just buy anything because you just hope to make a profit, probably not. But if you have the skill and expertise to identify and buy opportunities and turn them into outcomes that people are willing to pay you a premium for being able to achieve, then absolutely, today's a wonderful time to be investing. All right, how are we going with the presentation so far? Are we enjoying it? Are you still awake? Are you munching on dessert? Are you also watching, I don't know what's on TV at 7:30 p.m. these days, but whatever you're watching, Netflix? All right, good. Thank you for the positive feedback. For those of you who've just typed in a comment, much appreciated. Oh, hello, Emmy. Nice to see you online tonight. Thank you, Ian. Oh, nice to see you too. So we are investing for. Now we need to go back a step. What's a mistake that I see people make? The first mistake I see people making regularly is that they're investing for assets, not for outcomes. And so what does that mean? They're focused on the property, but they forget about the plan. They'll go to a buyer's agent and they'll say, hey, find me a good property. Or they'll jump on a real estate website and spend time just surfing, going, oh, that might work or that might work. They're not looking for something, they're looking for anything. And so they burn a lot of time. Yes, it might be somewhat entertaining, dreaming about what you could do with a property, but it's not strategic because you haven't identified what you're after, and so you've got no benchmark to compare that asset against in respect to whether or not it's suitable for you. Another thing people do all too often is that they invest for appearance, not performance. They buy using their eyes. They look at something and go, oh, that looks like a nice property, so it must be a good asset. Whereas really, as investors, because we want to make the most money in the quickest time for the least risk and lowest aggravation, we need to be able to quantify how much profit we're going to make, What's the time frame? What's the risk, and how much aggravation is there on the asset? And you'll see me do this later on with a little case study. And then I see this all the time. People are focused on postcodes over profit. They get into hot spotting and they're just listening to someone saying, oh, that's a hot suburb, you should buy there. And they run off and, like a lemming, follow, but don't understand what it is other than market, i.e. how to be a astute investor to accelerate the rate at which they multiply their money. Great. The second thing I'd say is that no strategy means that you must be a speculator. And so I like to differentiate the difference between choices and chances. If you're not making choices, you must be making chances or taking chances. If you're not making choices, you must be taking chances. And of course, the more things you leave to chance, the more chance there is that something will go wrong. The difference between novice investors and savvy investors is the amount of risk that they take. Novice investors take on risk without knowing it or being paid for it. Savvy investors take on risk and then manage and mitigate it to get it under control. Another thing that people do all the time as far as errors is they misidentify the real asset. The real asset in every situation is not the property. The real asset is the investor. Because if you know how to turn problems into solutions, you'll be able to go anywhere and make money out of real estate. How you make it may change over time, but so long as you've got the skill to be able to identify those opportunities and the skill to turn those opportunities into outcomes, you'll be fine. That's how I've been investing in 26 years now across all sorts of different markets across the world. Often people will have the wrong property and the wrong strategy because they don't have the big picture of what they're trying to achieve clear in their head. Or they go to their accountant and they get a real estate tax solution, which is not the same as a real estate investment solution. You may be able to buy real estate that somehow helps you to defer tax, but is it really making you money? Are you making the most money in the quickest time for the least risk and the lowest aggravation? All right, another problem I see people making, and this is the third problem, is they just have too many blind spots. It's like they're driving, but they can't see the full road ahead of them. And so once again, I reiterate about chances and choices, but more so, they're not measuring, and that means they're not monitoring. And if you're not monitoring, then you must by nature be flying blind. And you won't know when's the right time to sell or when's the right time to buy because you are just out there buying real estate. But buying real estate is not the same as investing in real estate. Investing is what happens after you've bought up until when you sell. Or as I teach, investing is what you do to open the transaction. Selling or buying is what you do to open. Selling is what you do to close. And investing is what you do in the middle. All the time I see this. People taking on unnecessary risk because they don't know how to do due diligence and or not being paid for accepting that risk, which is the very nature of speculating, isn't it? Right, so with that background in mind, let me show you a real deal that I was working on over the last 2 weeks and sort of came to a head yesterday. And hopefully this will bring into focus everything that I've talked about tonight. Are you ready? Yes? Yes. Are we ready? Are we good to go? Yes, good. Thank you, Anthony. Oh, Anthony, you're on tonight. Good. Okay, so we start this story in a little regional town of Queensland called Billawheeler. Billawheeler is about 2 hours, so west, a little bit southwest of Rockhampton, which is sort of in between roughly Brisbane and Townsville. There's your idea of where this is. A small little town. Why Billawheeler? Well, I happen to own another property in Billawheeler privately, or more accurately, my kids own one, because a bit of father nepotism here. I wanted to teach my kids how to invest in real estate, and I thought the best way for them to learn was for them to own a property. So, some time ago, and some of you may have seen the case study of the purchase of the Billawheeler ANZ. We're not going to talk about that tonight, other than saying if you were and you wanted to know if you were on that webinar or that series and you want to know how the asset's going, it's going fine. Nothing has happened. ANZ's still in there at this point in time and they're paying the rent each month. And my kids think real estate investing is fantastic. So where is this asset? This asset is on pretty much the main drag, Gladstone Road in Billawheeler. It's near the sort of shopping hub, and you can see here that it is this little portion of property. What is it exactly? Well, I'm glad you asked, because it is one of, I think, 4 offices in as a part of one building, and this particular property is where the dentist is fitted out. And here's a street view of what the building looks like, and the dentist is this little portion here where it says dentist. We have to sort of rotate this to get the idea, but here's 1, 2, 3, 4 tenant spaces in the building, and this is tenant 3, 120 square meters of land, and this is what we were told about the investment. CBD investment, highway frontage, netting, returning 10% net. Property overview: located in the CBD of Billawheeler with frontage to Gladstone Road, this commercial property is part of the ADS Professional Suites, a low-set complex constructed in 1973, year after I was born. ADS is the acumen for accountants, doctors, dentists, and solicitors. The complex is still home to Oxley Medical Centre, Sanderson's Park Solicitors, and a dental surgery. Adjacent to the busy Caribbean Court Shopping Centre and Billawheeler Shopping World. World of shopping at Billawheeler. The lease began in 22 and runs through to March 27. There's no options thereafter. We've got gross rent, we've got expenses, we've got net rent, therefore down the bottom, highlighted yellow, for the grand sum of $20,169 rounded a year. Okay, excellent. There's a little bit of background on the property. Now, a little bit of details of the tenant. The tenant is Bupa. They renewed the lease in March 2025 for 2 extra years. The rent is, as we know, $20,168. We don't know, but the asking price is $200,000. So our return, 2168 divided by 200,000, gives us a capitalization rate or return on investment of 10.84% per annum. Who's happy about a 10.84% return per annum? Yes or no? Yeah, anything over a 10 cap these days is like unheard of, despite the fact that it's in backwater Billawheeler. Commercial property these days is trading somewhere between 4 and 7.5 if you can find quite a good deal. So you could see why I would be interested in this deal, because yes, it's a remote regional area, but it's a cheapy cash cow. It's a great starter investment. The dentists typically are very sticky tenants because they've got to invest a lot into their fit out with x-rays and dentist chairs and blah, blah, blah. So it's a pretty expensive fit out for them. It would be a fantastic long-term hold, because at a 10% per annum return, you've got 10 years to lease it out, and then you've paid back all the money in the investment, and everything after 10 years is just absolute gravy on top. You've got no more risk capital in the transaction. You've been repaid. So under the whole, hey, girls, you already own one in town, why don't we double up on the daddy Nepo and acquire this as our asset? Possible Nepo deal number two. All right, so we get in and we start asking questions, and I would love to teach you how to do this. And in fact, I will be teaching you how to do this at the upcoming one-day seminar if you are coming along to it. The first issue we identified was that the heating, ventilation, and air conditioning, or HVAC, on the roof is a dinosaur. It might almost be original. And so it is coming to the end of its life. It could give up the ghost any day, and Billawilla gets very hot. It's the sort of place where you need air conditioning. It regularly breaks down, and it's going to cost $20,000 to put a new unit up on the roof because it's a sort of ducted unit and there's a bit going on to it. It's not just replacing a split system. So, how do we respond knowing that all of a sudden 200 could go to 220 pretty quickly? What would you do? Here's where you get to think as we participate in tonight's webinar. Anyone? Do we just go, oh, well, we just sit here and wait for the air conditioning to blow up? Or could we perhaps do something different? Sharon says maybe you could ask for a discount. Take it off the price, says Newman. Trade the price, says Leanne. There you go. Looks like most people are sort of saying do that. That's what I did. I did a retrade of the property and I said, look, we've got a $20,000 capital expenditure here. Let's just take it off the 200 grand. And the vendor agreed. All right, you got me. I'll accept 180 grand. So now we take the rent divided by 180 grand and our in-place cap rate has gone up to 11.24%. Who's happy now? High fives? 11.24%. There's probably not too many 11.24% tenancies leased to Bupa running around Australia at the moment. Yeah, great. Yeah. No, I wouldn't buy this in the fund. It's too small. It's just a great starter deal. It's not of the caliber that I would look to put in Sogov. Thanks for asking though. And I've got $20,000 that I've saved that if I have to put towards CapEx on the air conditioner or something else in due course, I can. All right, cool. Now we proceed to getting the building inspected. And there are some wiring issues that are identified. That's all right. That's a pretty easy fix. The tenant has to fix them up. But there's a mic drop moment. And the mic drop moment comes when the practice manager who's showing the building inspector around, who later reports this to me, is they say, oh, did you know that we've closed down? Huh? What do you mean you've closed down? You just signed a 2-year extension not 3 or 4 months ago to the lease. Huh? What do you mean? Well, yeah, we're closing down. I've already quit. I've moved to another job up the road and that's it. Show's over. Now what? What do we do now? Now that we've found out that there's a lease in place, but the business has closed down. This is when we kick into our due diligence and have to start asking questions. What would you do in this situation? Happy to read out your answers of what you would do next. Over to you. Panic? Run, contact the seller for more information. We're told that, no, we haven't been told that they're closing down yet. Ask for more of a discount, possibly look for another tenant. So what I did is I called the Bupa contact that I was given and said, I'm sorry to bother you. You're a very busy person, I'm sure, but could you tell me a little bit more information about the site you've got in Billawilla and whether you plan to continue trading out of it or not? That's interesting, you should call. It's not public knowledge yet, but we are struggling to find dentists who will work in Billawheeler. Even if we fly them in and fly them out for a couple of days, it's getting harder and harder to find people. So we've made the difficult decision of just closing down. And I said, well, that's very interesting, but didn't you just sign an extension to the lease for 2 years? Yes, we did, but now this has happened and we've bitten the bullet. We're going to try and get out of the lease. We'll give notice that we want to vacate early and blah, blah, blah. All right, now how are we feeling about this particular property? Are we as bullish about the property or not? What happens if they just stop paying rent? If you think, oh, well, you can go to a lawyer and sue them and they'll pay up. Remember, the rent's only 20 grand a year. You could blow a fair bit of money in legal fees and you might be right, but the tenant is a PTY Ltd subsidiary of Bupa. It's not Bupa itself, and they might just pull all the assets out of that entity and then you're suing a shell company. So, not as keen on it anymore, hey? So, they confirmed they couldn't get regular staff, so they're stopping business and they wanted to get out of the lease early. So, let's do a sit rep. Purchase price is 180. We know 18 months rent, if they stay there for the next 18 months and don't bump out, it's 30 grand, which really means that our risk capital is $150,000, isn't it? 180 less the rent that we're going to receive. But how long might it be vacant until you can find another tenant? What replacement rent might the new tenant pay? And even though I haven't written it down here, really the bigger issue is if you had to refit it, because remember it's special purpose dentist at the moment. I doubt you're going to find another dentist who wants to move in there. If Bupa can't solve the problem, you're going to struggle to solve the problem. And you wanted to refit it out to office, because remember it's accountants, solicitors and doctors and dentists for a second, you'd be up for the refit cost, which could be a fair bit of money by the time you put in carpet and lighting and you have to do the air conditioning system, etc., etc. So here's what I did. I wrote him an email, wrote and said, if we can agree on 150 grand, then that does two things for me. Remember, 180 at the moment. Allows me to accept a lower rent and still get a decent return, i.e. put another tenant in there, and gives me a budget to fit out as the make good in the contract says the tenant doesn't have to repaint or recarpet. That should say the lease. If that's agreeable, and assuming the lease is registered, then I can go unconditional straight away. So, what do we think happened? Steve has started at 200, retraded to 180, and now that we've found that the dentist was moving out, tried to retrade it down to 150. All right. Adam says that they said yes. What do you think? Here's the response from the agent, Mark Simpson. Hi, Steve. I spoke to the vendor and they won't reduce the price further as really nothing has changed with Bupa, and they might reopen or sell the dental surgery. The interesting thing is that we leased Bupa a 2-bedroom unit and have not requested to break the lease. Let me know what you decide. So they've come back and said, no, you're buying it at 180 or you're not buying it at all. So now we have to ask ourselves, are we in or are we out? All right, the risks are vacancy, the refit cost and the lower replacement rent. The aggravation, well, it's not as easy as it appeared, and might it turn into a nepotism nightmare rather than a nepotism blessing, in which case Dad won't be thanked for anything other than good on you, Dad, you made life a problem for us. So let's reevaluate. Risk capital 180, that's your purchase price. Vacancy, because they didn't accept the 30. Vacancy 6 months, let's say 10 grand of rent you don't get. 1 year lease incentive to lease it up, 20 grand. HVAC and refit cost 50 grand. means your new purchase cost is 260, and at 21 grand in rent, imagine you could get that. You're now looking at an 8.07% worst case kind of return. Is an 8.07% return enough for you to want to buy this investment? This is where you get to say yes or no. All right, Adrian's in. Sharon's still a good return. Yes. Benny's a no. Tracy's a no. Tim's a yes. All right, some of you are yes and some of you are a no. Okay. Well, I mean, someone's asking about financing, but if you had a home mortgage and you just took 180 grand out of your home mortgage and you're borrowing at 6%, you could get 8%, you're getting 2% for nothing, aren't you? Not suggesting you should do that, but I'm with you, Benny, on this one. So what's the conclusion on this particular example? Does the return cover the risk? Probably 8% for the risk. But does it cover the aggravation if the dentists move out and all of a sudden you've got to try and find trades in Billawilla and rip stuff out and the possibility more stuff is found? In my opinion, being an interstate buyer looking for a passive investment, the answer is no. So I said, thank you for the opportunity. And even though it is an 11.24% return, I'll pass. Steve said no to an 11.24% return because, yes, it was the most money and it was in pretty quick time, but for the risk and the aggravation, it wasn't worth it. Because the outcome I was looking for, which was to add another deal into the investing portfolio for the kids, I needed a simple deal for them to get the feel of it. Now, it might have almost been good for them to go through the hassle of a tenancy that goes wrong, but they're probably already going to experience that with the ANZ building when the ANZ bumps out eventually. We don't need to double down on the grief. Remember what I said about finding assets, and the right asset is the one that will deliver the right outcome? If I'm looking for an out of town, set and forget, passive investment, this would appear to tick the boxes. Lease to Bupa, good quality tenant, dentist, typically sticky. But as we did our due diligence and as we started asking questions, more information came to light, which demonstrated to us, or to me, that the risk and the aggravation meant the return was no longer worth it. So even if you can make good money in real estate, it doesn't necessarily even then mean it's the right deal for you. So what do we learn? The difference between a good deal and a bad deal is the detail. Well, let me go back one step first. Who would this property be a really good deal for? This would be a really good deal for a Billawilla local, or it'd be a great deal for an accountant or a solicitor or maybe the medical practice next door who was looking to get 18 months worth of income and then eventually refit it anyway for themselves. So this would be a potentially great deal for an owner-occupier or a tradesperson who was able to do the work at cost and then turn it around and refit it cheap. That would be a good deal for them as well. If there is in planet Earth a dentist that wants to move to Billawilla, they would be able to score a bargain here too. Now you could purchase this as an opportunity, right? And you could solve that opportunity by coming in there and finding a dentist to replace them or moving it, releasing it up. And not only would you make cash flow, you would potentially also then, if you put it under a 5-year lease, be able to retrade this on, say, an 8% return. So bringing my calculator just up on my screen for a second to show you how this would work. If we're saying that we're going to buy it for 180 and we've got $21,000 on an 8% return, it's worth $262,000 to an investor, 21,000, 5-year lease. And we know we bought it for 180,000. We're looking at 82,500. Let's just take 32,500 off for costs and mucking around. We're on 50,000, we paid 180,000. We're making a 27.78% return on value by just buying an opportunity and turning it around. Remember, you bank dollars, not percentages, though, Marty Ailes saying. But that said, it shows you how someone, the right person, this would be an opportunity for them to make potentially good money. What do we learn? The difference between a good deal and a bad deal is in the detail. It's very important that you buy on fact, not fiction, vis-a-vis it's a dentist, they've been trading there for the last however many years, of course they'd stay there. Or it's dentists are very sticky, they'll never move out, etc., etc. Something that I've learned is be very careful of deals that are easy to buy but hard to sell. If this became a vacant property, I think it would be much harder to sell than as an investment. All right, Tim says it's good to see the deals that aren't accepted. I'm glad you said that, Tim, because often I show deals that I end up buying and getting good negotiations on. It's also good to teach the fish John West reject and explain why, and I look at a lot of property, why this one didn't meet the grade, i.e. was the upside enough to compensate for the downside by a margin to take the risk. So there you go. I was hoping that since talking about this webinar and running the webinar that I might have been able to put this one in the property portfolio, but it wasn't meant to be, and so therefore you get to see a deal that didn't go ahead. If there's anyone out there in webinar land that would really like this deal because maybe it's an opportunity for you, I'm happy to put you in touch with the agent, or you can call the agent yourself or get in touch with the agent. It's Mark Simpson from Ray White in Billawheeler. Tell him Steve sent you, and all Steve wants for the referral is a box of chocolates, preferably favourites. Right, which brings us to the news of the details of a very special offer, which is great. Imagine we have spent 52 minutes together so far and you've learnt so much. What if we could spend a whole day together of structured Steve training? Imagine the insights and new skills that you would acquire that would literally unlock your potential as a real estate investor. What about if we could be working on your strategy? If I could give you the big picture plan, strategies and techniques and tools for accelerated capital growth, so you're not just sitting around waiting for the market to do something. Share more about what makes a commercial property a good cash cow investment, and then talk to you for the first time in many years about advanced asset protection strategies, opening up the McKnight Vault and sharing with you the way that I protect my own empire and the structures that I use and why I use them to protect my assets and legally minimize the tax that I pay. Well, that's exactly what I'll be doing for a one-time only in 2025 on the 16th of August in Melbourne at the Pullman on the Park, where I usually run my seminars. I'm offering 8 hours of intensive investor training with the goal of being able to equip you to do more in 8 hours than most people would do in a whole year or more. Plus, because we're going 5-star, the event is fully catered for in a 5-star venue, so we're going to be doing it top shelf. None of this cheap outer nowhere venue or anything else like that. We're going to go somewhere premium because we are dealing premium. The first session we're going to talk about is the big picture property plan. It is the missing masterpiece for so many investors because they don't know what the plan is. And because they don't know what the plan is, they fall for anything. I'm going to show you how to buy 10 properties in 10 years. And then I'm going to show you how to turn those 10 properties into $100,000 or more, and probably more, in net positive cash flow. Imagine where you would be in life 10 years from now if you were able to acquire 10 properties and turn the capital that you made in those 10 properties into income to ideally replace some, most, or all of the income you currently earn in your job. Session 2 is going to be accelerated residential growth strategies. I'll be talking to you about the shocking truth only a few people know about growth, how to put the hot into hot spotting by deal profiling areas and deal profiling properties. I'll share with you the 6 must-know growth drivers I look for before investing in an area or a property. And then I've got a little plus greater than dollar formula, which if you know and apply, you just can't fail to value add on your investments. Session 3 is going to be cashing in on commercial, what to look for when buying cash cows. Advanced risk assessment will go into greater detail than what I've showed you tonight. And I'll share with you how I made $1.6 million in 6 months in 2025. That is a great case study. And then we'll wrap up the day with advanced asset protection. And I'll show you how I control everything but own nothing, how I legally cap my tax rate at 30%, and how I am able to qualify for an unlimited borrowing limit based on the way that I structure myself, and how you can too. Included will be a comprehensive Keep Forever workbook, plus also the full slide deck in electronic format, so you're not taking photos or trying to copy down the slides. I'm going to give you session 1 for free, the masterpiece big picture. Session 2, Resi Accelerators, $6.95. Also in session 2, we're going to be hearing from Belinda Smith, who's going to be showing us how she's renovating properties right now to add value, accelerated value to her residential acquisitions. Session 3 on commercial, $6.95. Session 4, Lock the Vault, $6.95. The workbook and the slide deck, all up $2,875 worth of real value. Now, someone told me today they were about to sign up for a mentoring program that was going to cost them nearly $15,000. And I am pretty confident that you will get much more value out of attending a session like this for a fraction of the price. And all I'm asking is $995, not $2,875, just $995. But wait! No steak knives, but for the first 29 people who book tonight, as a result of this webinar, I'm going to give you 5, count them, 5 amazing bonus items valued at $1,495 for free. What are these 5 bonus items? The first is you'll get the whole seminar on audio, so you're able to listen to all of it or parts of it whenever you like. I will then give you something that's going to be exciting. I'm going to grab the audio and I'm going to turn it into a comprehensive, thick transcript converted into a detailed, comprehensive training manual. I've never done this before. This will be the first time I've done it at a seminar, and you walk away not only with the audio, you end up with the transcript as a how-to manual. Bonus item number 3 is I'm going to give you what I call Telltale. I've got a tenant interview template, so when you interview a tenant, it gives you the questions that you need to ask in order to unearth the information like I found out in the case study that I showed you. I'll give you the same Telltale agent for how I interview agents and also how I interview owners. Now, this is proprietary Steve McKnight questionnaires that I have developed based on my 26 years of investing experience buying and selling hundreds of residential and commercial properties. So we take the 2875 from the one-day training, we add on the bonus items, that's $4,370 worth of value. And I'm not going to ask you to pay $995 because you're here with me tonight on tonight's webinar. I'm going to reduce it, but only for the next 29 people, and I'll explain why in a second, to $695. One payment of $695. And just in case you're wondering whether it's going to be worth it, it's backed by a complete money back guarantee. You can stay up until lunchtime, which will get you through sessions 1 and 2. And if you're not 100% satisfied, I'll give you a full refund, no questions asked. Couldn't be fairer than that. But Steve, I'd like to get the recording and the event assets and all 5 bonus items, but I can't make it to Melbourne on that day. My insert reason here means that I can't come. Can I still get them? The answer is absolutely. I'm trying to cater for as many people as possible. When you proceed through the checkout, assuming you want to come, you've got a choice between either coming in person or then choosing the audio and bonus items only. Same price for both, $695. So what is the secret link? You won't find this link online anywhere to go ahead and book your place. www.PropertyInvesting.com/PS25. Make sure you put the www3 in there, otherwise you won't see it. Now, I'm telling you there's only 29 spots left because there's only 29 spots left, right? There's not 30 spots left, there's 29. It's hard coded into the system. When those 29 spots are taken and they're allocated sequentially, right? First come, first served, the event will then automatically say sold out. And when it does, if and when it does, you'll only be able to purchase the recording option. So if you would like to book in and you want to make sure you get your spot, but you're not sure if you can come, you can book in tonight and you've got 24 hours to cancel and I'll give you a full refund, right? That way you've reserved your spot, and if you decide that you can't come, you can always pull out in the next 24 hours and I'll give you a full refund. So with that in mind, I'll answer one little question and then I'll throw open to questions. But now that we know that interest rates did not change today, or the cash benchmark rate did not change, Steve, what's your read on the no change to interest rates? Well, first of all, I'm happy to admit that I was surprised that interest rates didn't go down. I thought they would have. I thought there was enough doubt around what's happening in the world and a lack of confidence to cause the RBA to want to stimulate. The fact that they didn't, and the fact that it was a 6-3 split, means that I'm not quite as sure that the future interest rate decreases that we all thought were going to happen will happen either. But be that as it may, I think it means that real estate will continue to bubble along. I think if they had dropped interest rates, then there would have been some more froth and bubble, particularly in the residential real estate market. And what that means is it buys us another month, because the next meeting, RBA meeting, is in August, to get our strategy right and to look at buying property that makes sense for us before falling interest rates cause it to become a hotter market. With that in mind, without giving anyone any advice, it's certainly a situation where I think interest rates are more likely to go down than go up. So fixing interest rates as a rule, you'd want to have a reason for doing it, unless the fixed interest rate was so far below the variable rate that you think it's worth it to lock it in. That's something we're looking at doing in the fund that I run, for instance, is taking a portion of our debt and locking it away for 5 years, locking it away for 3 years, and leaving a portion variable, so that we've got a way of managing interest rate risk in the forward period. Okay, so I hope that has helped you to find out more about that matter. I've got some time now to answer any questions that people might have. So if you've got a question you would like to ask me, perhaps about the deal that we looked at, or alternatively anything else, you're welcome to pop up your hand in the area and I can come to you, or you can type your question in the box and I'll try and read it out. Adrian's coming on the 16th. I look forward to seeing you then. On bad commercial real estate deal, how much time did you spend reading the detail, and what is the detail one should read? That's how long did I spend looking at it? Maybe 6 hours tops, maybe not even that. 4 hours, 6 hours. Got to read the lease, got to read the contract, building inspection, reading the building inspections, emails backwards and forwards. Yeah, I would have said 4 to 6 hours. Jenna wants to know how I became aware of the deal in Billow, because I work with the agent and he's the one who manages the ANZ for us. ANZ Property Management. I quit my job and have gone back to full-time study. Hey, Daniel. Which means I can't get a loan despite having a deposit. Any suggestion? It's a bit hard. You might have to use joint venture money if you know how to access it, Daniel, or just become a deal finder for someone, subject to the legal ramifications of doing that. Right. Hi, Steve. I'm looking at Vic Resi. Most of the things are fine. The biggest thing you've identified is 2 gum trees on the site. Yep. Well, that's when I would go and get an arborist on the job. Oh, wow. People are really firing in questions now. It's a bit hard to be able to read them all. Any deals on the Pullman come to light yet, Steve? I'll need to follow up with Romy on that. Judith, but you're welcome to call the venue and tell them that you're coming in and just ask them if they offer you a corporate rate. What's the website to sign up? Hopefully you can see that on the screen now. Sure. Steve, did the RBA have its own Trump takeover moment by not cutting rates? It's kind of hard to know, isn't it? But it was surprising they didn't cut the rates, Simon. So, yeah. It sounds like you're buying mostly commercial properties. I am buying mostly commercial properties at the moment because I've moved out of the capital accumulation phase into the income investing phase. My biggest problem at the moment is deploying my capital into income producing assets rather than growth assets. But not everyone's at that stage of their life investing journey. Hence why I want to talk at the start of the seminar about the growth drivers to look for if you're after growth more than income. In this market, would you still use the 3-2-1 method from the return analysis? Geez, Gary, you've been around a long time. You absolutely could if you could apply that to the market and find a deal that suited. Steve, you're welcome, Tracy, where do you start to look to find these deals? Well, Alan, hopefully you're able to come to the seminar because that's what I'm going to show you. Paul, it's the same webinar on the same seminar that if you've booked in for the 16th. I'm only doing one day seminar this year. All right. It's not on the screen. I think it is on the screen. It should be on the screen. Just give me a second. Yeah, it is. www.3.propertyinvesting.com /BS25. Yep, it's on the screen. People are saying it's there. All right. Well, with that said, I'm going to wrap up and head downstairs and say thanks for joining me on tonight's webinar. Hopefully I've answered that question. Can you still make good money from real estate? And giving you some tips on how I go about finding great deals in the market and what I do to qualify them to try and work out whether the property is going to make me the most money in the quickest time for the least risk and the lowest aggravation. I really do hope you're able to join me at the one-day seminar in August. I don't do many seminars anymore because they take weeks of work to prepare for them and time to recover. So please take advantage while it's on offer and before it sells out. Thanks for joining me tonight. I look forward to seeing you on the next webinar. Until then, good night, God bless, and goodbye.